Welcome to Beating Sisyphus, a production of the Canizares Center for Emerging Markets in collaboration with the Emerging Markets Institute Club, live from Ithaca, New York. Beating Sisyphus brings together leaders across economics, tech, finance, policy, and entrepreneurship to explore how innovation emerges under pressure, under difficult conditions in emerging markets. Today, we are honored to welcome Adrian Leon to the program. Adrian is a CFA, a charter holder, and recent Cornell MBA graduate, specializing in global asset and wealth management. He brings extensive experience across estate planning, investments, and tax strategy. He currently serves as vice president of Insigneo, a firm managing roughly about $35 billion in client assets, and also authoring a forthcoming book on money management and financial literacy. Prior to Insigneo, Adrian spent nearly a decade with Guggenheim Partners Latin America and holds the Series 65 license. Adrian is deeply passionate about education and helping families and institutions navigate their wealth through a holistic framework that integrates law, finance, and tax, the three wealth pillars. Adrian, thank you for joining us today. So please explain your current role and why you decided to get into this world of global wealth management.
Cool. Thank you, Lourdes. And first and foremost, thank you for having me here and being part of this episode. Really excited. And nothing to your question, I would like to first begin with a quick note. The views here and opinions expressed are my own and provided for educational informational purposes only. They do not represent the views of Insigneo, and nothing here should be considered investment advice. Having covered that, generally speaking, my role is helping families and institutions with their goals via a highly personalized and independent perspective. The educational book and platform you mentioned that I'm working on touches on what I have seen throughout my career, and what I like to call is the three wealth pillars. It's essentially the law, the finance, and the tax side, or estate planning legacy, or legacy planning, I like to say, money management, and the tax considerations. To your questions of how we got here, long journey, but it was a strong pull, I remember, since high school. There was this looking at colleges and deciding for future careers. I tried exploring, at one point I remember, architecture, but I couldn't draw a stick figure to save my life. So, but like, the decision was pretty much clear then and there. That architecture was definitely not for me. And then I started, I applied to a business school, and at 18, I had my first investment account and started getting that exposure. And since they didn't offer classes that covered this, I started following TV, CNBC, Bloomberg. I bought some books on the side and just started investing and learning on the side. It's completely on my own, and I guess it showed the passion I had for it at a very young age. With experience, I learned the importance of having a global view, a global perspective, diversification, and the benefits in not limiting your options to any one region or country. And yeah, having a global view allows for a basket of global opportunities. And just as there is amazing talent in companies here in the US, there's also great and unique opportunities abroad. And specifically on EM, EM has greater inefficiencies and more challenges. However, these inefficiencies and challenges create for greater opportunity and greater chance to add value.
Adrian, well, thank you so much for that fascinating introduction. It's cool to hear about your story, how you've grown in terms of your passion for finance. I wanted to turn a little bit just so our audience can understand. When we talk about emerging market equities and emerging market bonds and these indices, what do we mean? And, why do you think investors may want to consider that, these companies domiciled in other countries, when U.S. companies already have significant exposure to, different global revenue streams?
Perfect. So regarding that, a global diversified portfolio means having all the exposures of all the sources of revenue of streams around the world, not just one company or one region. And the same goes for emerging markets. It's having this piece of the puzzle for that full picture. On a top-down basis, one country region might do well for a few years or even decades. The U.S. has been outperforming in the capital markets for the last 15 years, and for some that's almost a lifetime. Now, these economies or markets work in cycles, so trying to time this is very difficult. Which region is going to do better, and even if 15 years is a long time, eventually the pendulum swings and there's going to be areas that do better over time. So it's difficult to time. So just have all the regions or have exposure to all the countries and regions so you can cover and capture all the cycles. There's an expression that I like. I read once that goes, instead of trying to find the needle or the region in the haystack, just have the entire haystack or buy the whole haystack. We saw top down, now bottom up. The views, yes, the S&P 500 has about a third of its revenue from abroad. I think that it might even be more recently. However, it does not have local plays like the local consumer going to the corner store, the local utilities. Utilities are very locally driven, and the same as local banks. So these segments are less represented in multinationals or revenues of this U.S. index, the S&P 500. It is a bit stale, the one that I found, but this graph by country makes a point that China and Japan and Brazil range from 1% to 4%. So it's these economies are huge, and Brazil represent 1%, China like 4 or 5. It's very little of the revenues of the S&P 500. And again, this data is a little bit stale, but it makes the point that you have to have that direct exposure, ideally, for that diversification benefits. Then there was a slide I shared on my last seminar, and you can see in the MSCI Global Index and how it's composed by different countries and regions. Mostly it's the US, so about 65% is the US capital markets. And then Europe is about like 10, emerging markets about 10, 11. Japan is about 5. And this is from JP Morgan Guide to Markets, a great presentation. And there you can see how in 1987, the US was about 30% of the global capital markets, and now it's 65. So you can say it doubled. Japan was really eye-opening. It was about 40% of all the world's market, and now it's 5%. So the importance of diversification. Yeah. And then emerging markets was about 0 to 1% in the 1987, early 90s, and now it's 11%. So you can say emerging markets 10x. And then, that a little bit regarding how this global index is composed of each region country. We spoke about stocks, but what about the bond market, which is huge, just as big or even bigger? The same thing. The bond market, emerging markets back in just 2 decades ago, was almost non-existent, and now it's about a third or 28% of all the bond market composition. It's about the size of all of Europe, Japan, and all of developed markets except the United States. So the United States is about 37, 38%. Developed markets, excluding the US, is about 33, 34, and EM is about 28%. So it's in dollar terms, it's 44 trillion. Wow. So imagine having this huge market at 44 trillion and not looking at it. It's kind of like trying to cover the sun with your finger. So that's a little bit of an analogy there. And regarding valuations and cycles, again, another slide that I spoke of last time, this graph shows that every region has its cycle or its time, and extrapolating past success of a region, even if it lasts for a decade, is a behavioral bias. I saw that in one of my classes here in Cornell, the importance of behavioral finance, and extrapolation was a big behavioral bias. Oh, this has been doing great, and it doesn't mean necessarily that it will do that so forever. Investing is a lifetime process. So the importance of covering all regions for all cycles.
Yeah, well, that's an excellent justification. I really appreciate this super thorough and detailed answer on that front. Now that we have a understanding of why really investors for their portfolio should be considering emerging markets, I wanted to dive in a little bit into your framework. So when you're talking about analyzing emerging market equities as well as debt, from what I understand, you start with the macro fundamentals: fiscal and monetary policy, growth and currency stability, along with leverage and foreign exchange reserves. Could you walk us through kind of this process using these macro variables when you're looking at these individual emerging markets?
Perfect. Yeah, we'll break it down. It's a lot of information, and but I will break it down to make it as simple and understanding as possible. And some of these metrics are very basic, even though they sound technical. So this framework was part of what I studied and saw many years ago while studying for the CFA exam. And then I added a few points such as M2, which is just how much money is in bank deposits, the money circulating, and as well as short-term interest rates, whatever the bank is dictating rate should be. So I added those two to the framework. And for this, tracking these matrix over time, you can see kind of the situation of an economy. So it's important to be aware of them. And to make it simple, just 3 takeaways from this framework is, again, a big one that you see on the news is deficit, or the fiscal spending of the government relative to GDP. In EM, in emerging markets, and in general, anything less than -4 indicates credit risk. If you're spending more in the government, more than you're taking in, and if it's at 4, you run a small deficit, I guess it can continue, but it can get larger or continue forever. And then regarding debt to GDP, this metric, I remember I saw it many years ago, and it resonates everywhere. Even in the EMI conference that we were, someone else brought it up. So it was interesting to also see it. I guess it's kind of like gravity. It's a number that just works and it pulls. And in EM, debt to GDP is about, once you reach more than 70% of public debt, it can be troublesome. And especially if more than half of that is owed in foreign currency. Because if you owe it locally, like Japan, then it's a little less risky. But if you owe it to someone else and in another currency, it could be a problem. So that's the deficit to GDP, debt to GDP. And then the third, more simple takeaway is higher rates or short-term rates. Higher rates means safe, you get paid more, but also means lower asset prices. So bonds fall, stocks usually fall. And then vice versa, lower rates equals just borrow, invest, consume, and that brings up asset prices. So 3 takeaways from that framework. And then the rest is straightforward. M2, money in the system. If there's more, probably more growth, but also more inflation. And then reserves, FX reserves. More is better than less. So you could cover your near-term payments. And finally, GDP growth, another basic metric. I think productivity and tech is really a key component of GDP. Labor and capital are important, but tech, I think, is what really has helped the innovation, the US in this last decade or more. So yeah, for me, I think productivity is key for the long run. Yeah, that a little bit on the investing framework and those 3 takeaways.
Absolutely. Wonderful. Well, thank you for that analysis there. I was wondering if we could get maybe a little bit deeper on some of those macro variables. I would say beginning with fiscal policy, what are some ways that you see directly, deficits and debt along with overspending leading to lower investment returns, hurting equities? I think on the bond side, it's pretty clear, if someone's investing in a government bond and that government is then running very large deficits, has a very heavy debt burden, especially when it's denominated in dollars, there's a much higher risk of default, the risk that you lose all that money. But when we think about equities, how might investors go about approaching that? Obviously, there's going to be a lot of, impacts that will hurt those companies domestically if the government does default. That's, kind of generally how, nations tend to fall apart in a lot of ways. But on the spending side, as well as just running large deficits, when those are funded, what ways do you think equities in particular might be impacted?
Great. No, and very timely and relevant to our times, this question you bring up, because see the debt and the deficit are all over the news. And higher debt leads to higher interest payments versus money going to more productive uses in society, investing, expanding capex, hiring. So money just going to pay off interest is not the most productive use. In the US, the debt levels, I say it's timely because they're as high as they were post-World War II. And yes, we came from COVID, so there was a lot of spending and debt built up, but we are at very high levels. In perspective, the US spends about $1 trillion in interest payments, just in interest. And it's about the same amount that goes to it's part of the defense budget. In perspective, Social Security is 1.5 trillion, so it's a big chunk that we're paying in interest. On an income perspective, I thought that was interesting. It's more than double than what all US corporations pay in taxes, and it's all going to just interest. A quick parenthesis on that is everything in the world of relativism, everything is relative. So debt can also be good. If well managed within healthy levels, that can be good, especially at low rates. If you have a cheap debt or a low interest to fund capex, to fund productivity that leads to returns that are higher than costs, that's good. Now, the other side, if interest rates are high and they are higher than what you can expect to make, then no bueno. Well, that's not good if your interest is more than what you can make. So everything is relative. Some people are just no debt, no net, and I think it's a balancing act.
If we could touch a little bit now on, we have the fiscal side understood. Clearly those interest payments can be a serious problem when you have a lot of those tax dollars going directly to fund those things. The obvious default risks are quite clear. Additionally, crowd out as another important aspect. On the monetary front, though, how do you think about the relationship between inflation and equity returns? In a lot of cases, some might think that those companies in some ways might be able to increase their future cash flows because in nominal terms, they're able to increase their prices and thus kind of offset the inflation. Do you think that exists in emerging market economies? Are these companies able to offset that increased inflation when we have an increase in the money supply, obviously leading to higher inflation? Are companies kind of able to offset that? And when we look at equity markets, do you see them performing worse or better under those high inflation scenarios?
I like that. I was just at a conference hearing Jeremy Siegel's Thoughts for the Long Run. Amazing speaker. It was I think his 80th birthday, and he touched on that point that I guess a protection to inflation is equities, even though they zig and they zag. Companies, when you have a stock, you own an asset, and that asset, like let's say you own shares of Coca-Cola. If inflation is 3%, they can raise the price of Coca-Cola and they can compensate for that. So you are somewhat protected. They can even raise it more than inflation and make a profit. And that depends obviously on the product and the moat, so to speak, or the pricing power. So having stocks can protect you from that. In bonds, less so if you have fixed 3% for 30 years and inflation jumps from 3 to 10, then you have a problem because you are fixed with what your return stream is. So, and I like this perspective I heard in a conference once, that risk is not the ups and downs of stocks. Real risk is losing your purchasing power. It really stuck to me. And especially coming from Latin America, where you see a lot of inflation and the erosion of purchasing power, it's crazy. I saw it in one country, my country in Ecuador, how during the hyperinflation that there was, I would come back with dollars and I was able to buy more ice cream. And I was like, wow, this is great. Like every time I come back, I can get more ice cream from my friends. I was very young, like 6, 8 years old. And it just, it really, really made an impression on me. But yeah, big picture, all else equal, higher rates equals lower asset prices, and lower rates equals higher asset prices. And then the same thing with money supply.
Absolutely. Well, thank you for the, touching on both fiscal and monetary policy side. I think that's super important when considering those macro variables. Could we maybe turn now to, some important governance quality, as well as legal protections, as well, and political institutions? How do you think those interplay with both debt and equity markets and the returns that investors could be expecting when they're analyzing these emerging market economies? In other words, how important would you say that, the government is and institutions in terms of protecting, investors' capital and just increasing access overall?
The answer is kind of straightforward. And again, big picture, a more stable currency, a more stable government is just allows for easier planning for business, for life, versus having to move or jump through currency swings and changes of law. So quality matters also in how the currency is held. If it's artificial or temporary, it eventually could break, versus a solid economic foundation that the currency is stable because the economics are stable. And then on governance, quality, legal protections, bottom line is kind of a common sense also answer is rule of law and a just judicial system are key for trust. And yeah, if rules are being changed every presidential election, then that's not going to allow for long-term planning. So just a few basic points there.
Yeah, absolutely.
But very important.
And in your experience, with global asset management, have there been any situations or areas, just from your experience, that you could maybe touch on in regards to kind of going through political turmoil at all? And how you see your clients' portfolios, or maybe how you see your investment philosophy being shaped and being formed through those situations?
I guess, again, touching on the main point at the beginning, just diversification is key. Some regions might do better than others, more inflation, less inflation, more stability, but just having it all kind of protects you in some way, having that diversification. So, yeah.
Yeah, so now I'd like to turn a little bit, we talked, you touched a little bit on cycles. And one thing with these cycles, I was wondering, we've seen a lot of relative overperformance by U.S. markets in the past, 15 years or so. Would you say that, given now the relative overvaluation of those U.S. markets, would it be possible to see a cycle reversal? Do you think that's something in the cards? I know you talked, again, very important to consider consider diversification in one's portfolio, things along those lines. But what do you think are the key drivers of that underperformance, relative underperformance in these emerging market economies?
I think to start off, why the U.S. outperformance was post-2008, interest rates dropped massively and they were very low for a long time. So that helped, nothing is cheaper funding cost, expand production. There was very low rates, so just higher asset prices. Then there was a huge stimulus post-COVID. It was the biggest since World War II. So a lot of money going into the system, low rates. And yeah, it helped us, but it also caused a little bit of inflation. So that has helped the U.S. And now on the macro side, and then on the market side, tech. The U.S. has become a very tech-driven. So that's tech commands a higher premium because the margins have gotten better. Earnings growth is a little bit higher. Just that's how tech behaves. So because the U.S. market has evolved into more tech-based, then yeah, those companies have a higher valuation. So that has been the case in the U.S. And then outside of the U.S., valuations have been lower. Sometimes it's just less liquid markets. Sometimes political instability. So those can be some of the reasons why outside the U.S. There hasn't been, or the valuations are lower. Liquidity, political instability, and I guess maybe that lack of, or not as much tech-based as the U.S., which again is more growth and more higher profit margins. In emerging markets, Asia, to make a clear distinction, well, the Asian markets have more tech in their composition, and then Latin America is more commodities based. So that's more cyclical. It can have the booms and busts on LatAm. So that clear distinction.
Gotcha. And so you would say those, the relative outperformance and underperformance, with that, would you say that the, again, relative undervaluation of EMs is primarily driven by the fact that the U.S. markets are dominated by these large tech companies that tend to command those higher valuations? Or are there maybe some other factors? Again, I know institutional quality is a huge part of it. But even, when looking at, like you mentioned, the Asian markets that do have high tech exposure, would you say there's still that kind of relative undervaluation? And are there kind of any reasons behind that? Or would it all be explained by basically the composition of those equities that exist in those markets, as well as the governance quality that exists?
I guess in these Asian markets, they have more tech versus Latin America. So more tech similar to the US. Now the US is a much bigger, deeper market, so more liquidity, and that commands a premium. That rule of law, that I guess political stability, even though we've seen a lot of headlines, but I think in general that is more true than not. So that's, in my opinion, I think commands that higher valuation and these giant companies. So I think that's a little bit of the reason. And then I would say that, yes, the US has done better for the past 15 years. This year was the first year in 15 years that other markets are doing better. And I don't know if it's the start of something. And past performance is not indicative of future returns, is a disclosure. But the point is, don't extrapolate. Again, what I mentioned at the beginning, even if 15 years does seem perpetual, over a lifetime, this should fluctuate. And yeah, again, that point of having diversification.
Absolutely. And in general, I know, again, hammering home the importance of diversification. I think that's kind of a huge takeaway from this talk. Would you say there's any other practical takeaways that our audience might want to keep in mind when looking at emerging markets? I know, a huge thing would be incorporating these pillars that you've mentioned and your investing framework. But, I guess on a more application side, what are some ways that investors could look to increase their global exposure if they think this is something that could help for diversification of their portfolio?
Hopefully the framework helps, because once you have those points of the frameworks, then you could look at any economy and analyze it yourself, because they're simple and very straightforward, like GDP, FX reserves, debt, deficit. So just you can take that framework and then look at where you are from, or where you want to analyze, or where your friends live, and you can use that. And then I guess my call to action is learn about emerging markets, its drivers beyond investing. If you live there, you work there, you have a business there, or you have a friend there, learn about them, what drives it. And then there is research from the big rating companies, but it's also important to do your own work, your own research, and your own critical thinking. And finally, again, you mentioned this diversify among many asset classes, asset types, and consider EM.
Yeah, absolutely.
Thank you very much. And then the last question, one emerging market and why?
One emerging market. So in the last presentation we saw together, I did not know this, but I guess it came through that to doing the framework, to doing the analysis. India stood out, and yeah, that was something that surprised me from my findings. But again, don't extrapolate. Do your own research, and make sure that whatever exposure you decide fits your own personal goals and your situation. But that definitely stood out, India, and the returns were very interesting. And what really stood out was the risk, or the volatility was not as high as I would have thought. But again, that's past performance. Do your own work, your own research, and yeah, something that see what fits your own goals.
Thank you very much, Adrian. Definitely you were saying the importance of emerging markets, the growing importance in the last 25 years, in the last 15 years even more, and the need, as you are saying, for critical thinking, to know more about emerging markets, because number one, the US companies are exposed to sales revenues from emerging markets that are very important, and also because emerging markets have become much more important in terms of GDP and everything else, and definitely for investing, a source of gains from there that are always underestimated. Sometimes our perception of risk is more than the reality is. So by getting to know them, this perception of risk is more realistic, and we can take advantage of the situation and the growth and the innovation that is in emerging markets. So thank you very much, Adrian. Thank you, Thomas, and looking forward to the next discussions.